I'm getting better about the actual stagecraft.
Yeah.
Hi, everyone, and welcome to another episode of Hello Haymarket. My name is Dana Nyce, and I'm here with our special guest, Coleman Bales with McLean Mortgage.
Thanks for having me.
Absolutely. Today's episode is going to be about what everyone needs to know when they're thinking about buying a house. What do they need to clean up in their financial life in order to be attractive to a mortgage lender? In fact, maybe we should just start with an introduction for you and what your role in the process looks like.
Absolutely. So like Dan said, I'm Coleman Bales. I work for McLean Mortgage. I'm Dan's preferred lender, so we're working together on a day-to-day basis for
100%.
Everybody that's looking to buy a home. Basically, what I do, what a mortgage loan officer does, is we help come up with a client's budget, right? So I'll talk to a client. We go over a whole application, and I use all of the info on this application to come up with the max budget they qualify for, how big of a mortgage. We pull that back until we find something that they're happy with is on a monthly basis, because you're going to be making this payment every month for 15, 20, or 30 years. And then also we balance the monthly payment with what your out-of-pocket upfront expenses are. So like your down payment, your closing costs, everything that you pay at the closing table. You can always pay a little bit more at closing to have a smaller monthly payment, or you can pay less at closing at the expense of having a slightly higher monthly payment.
So if you would think of your agent as the person who's kind of guiding you through the process at large, your lender is the one who's going to be handling everything to do with your financial life. So a lot of the times when I'm working with someone, they'll ask me a financial question like, what kind of loan do you think would be best? Or do you know of any secret ways to reduce how much out of pocket I can have? And while I do know some of that stuff, I'm not the guy that you ask. The guy you ask for anything finance related is going to be your lender. Right, 100%. Because anything I know, like he's going to know it 10 times better, and he'll explain it in a way that you'll understand it better. I think from there, let's actually jump off into what are the key things that a lender is looking for when they're trying to determine, first of all, if they're willing to lend any money to someone to help them finance the purchase of a home, and then furthermore, how much they're willing to lend. So what are those key things you look at?
Absolutely. So to break it down into the four most important things that we're looking at: income, what do you do for a living, and where does your income come from? Your assets, as far as how much do you have saved up for your down payment and closing costs. Credit, what's your credit score? What's on your credit report as far as payments in the past, late payments, delinquencies, bankruptcies, everything that would be on a credit report. And fourth is collateral. So the actual property itself can have a big impact on what loan programs make sense. So income, assets, credit, and collateral.
And these are the things that they look at, and they look very carefully. Because if someone's going to be lending you hundreds of thousands of dollars, they want to make sure that this is going to be a wise investment and that they're going to be able to get their money back. Right?
Absolutely right.
So to that end, let's dive into the first one, which is going to be income. What do we need to know about income in order to be in the best possible position to buy a house?
Absolutely. So it's everybody's different on the income front. So I'd say the most important thing to realize is that what you think your income is and what your income actually may be when you take home might be different than what a lender is going to look at for your income. So we were talking earlier about different pay structures. Some people, they make a yearly salary, and it's very clear. In a year I make X amount of money. And so, I look at things on a monthly basis, so I can take that yearly income, divide it by 12, and I know exactly what your income is. That's a fairly, easy income calculation. Yeah. Other folks it's a little bit trickier. So it's trickier for folks that, maybe self-employed, maybe they're just commissioned salespeople.
Like me.
Right, exactly right. Me too.
Right.
People whose pay fluctuates over time. That income's looked at a little bit differently. So for example, we usually average variable income that changes over 2 years. So like if someone made 10 grand one year and 90 grand the next year, it went up, 9x.
Yeah.
Instead of looking at it like you make 90 grand a year, the underwriter's going to say, oh, over 2 years, they made $100,000. So that really averages out to more like $50,000 a year. So even though maybe, yes, you are taking home the equivalent of like a $90,000 a year pay structure, you're gonna qualify for a loan like you're on a $50,000 a year income. Yeah,
that's exactly what happened with me when I got started in real estate. I wasn't able to qualify for a loan the first year because I didn't have 2 years tax returns showing what I was making in order to get that average.
Yep.
Right. So that's definitely going to impact the timing. But what else is going to be in consideration? Is it just how much you bring in, or is there something else that's going to affect the income calculation?
Great question. So yep, it's income, and it's it's not just what you say. It's how we calculate income, and then there's debt. That's the other side of the equation. So it's something called your debt to income ratio. this is what we're looking at when we're determining the max of your budget. You have X amount of income. The question is like how much of that income, how much are we going to allow you to spend on debt, right? The debt to income ratio, it's not just the mortgage payment. We will look at that by itself, like how much is the mortgage in comparison to how much you're making, but it's really the mortgage plus any car payments, credit card payments, student loans, anything that's on your credit report, all of that stuff gets added up and compared to your income. And that's called your debt to income ratio. We can only lend a certain percentage of your total monthly income.
Yeah. And that makes perfect sense if you guys just think about your own household budget. If you're spending $500 a month on an auto payment for your car, and let's say you make $2,000 a month, and then you're spending like another $1,000 on, I don't know, a student loan, you're living at home with your mom and dad or something, like there's not a lot of room there for you to have to pay off a mortgage. Right? Exactly. So a person in that situation, yes, making more money would help, but another way to attack the same problem would be to eliminate that debt. Mm-hmm. Does that basically summarize that pretty well?
Absolutely right. Absolutely right. And it's important to look at too, because we were just talking earlier about there's been situations where somebody gets under contract and they don't ask their lender, but maybe somebody goes out and buys a car. Right? Oh yeah.
I've seen that.
Yeah.
I'm getting ready to settle on the property and I see them drive up in a brand new car and I go, hold up. Wait, what just happened? Did you clear this with your lender first? Because they are going to see it.
Exactly right. So if you were maybe working with an online lender or someone who's not local, that maybe they didn't go over it, at the beginning. Some folks they just don't realize. But yeah, so say you're in a situation where your debt to income ratio is close to the max you qualify for. You get under contract to buy a home, and then you decide you also just happen to need to buy a new car. If you buy a new car and that new car has a payment, that's going to impact your debt to income ratio, and you may not qualify for that house that you're under contract for anymore.
Yeah. I mean, if you were under contract to buy a house at the top of your budget, call it $400,000, and now suddenly you've got a $500 a month auto payment, that's going to reduce how much you could qualify for. So when you go to settlement, the loan's not going to be there, right? Because the most you could qualify for is going to be less.
Exactly right. Right. Yeah.
So you definitely want to avoid a situation like that. Just wait until you're settled in the house, buy the car after. Just be patient. Get to closing, get the keys, then talk about it later.
Yeah, it's a bit easier to get a car loan than a mortgage.
Much easier.
Yep.
Yeah. Okay. So that I think covers foundationally what we talk about when it comes to income. Let's talk about the next piece of the pie.
Okay. So income, assets is the next thing. So when talking about assets, the things that we're talking about is really your out-of-pocket expense. Like how much is it going to cost to buy this home?
Yeah.
So there's different types of programs that we have. I'm just going to go over first-time home buyers. The most common ones are going to be either your conventional loan program. That's typically the most common for for someone who has good credit and who's not a veteran of the military. A conventional loan is usually what you'll go with. There's FHA loans for folks that have credit that's a little bit lower or a little bit, under 660, 680. If your credit score is below that, an FHA loan is probably going to make more sense. It may be the only one we can qualify you in certain circumstances.
And what does FHA stand for?
Yep, it's Federal Housing Administration? Federal Housing Administration, yes.
Okay.
Yeah. Okay. So, yeah, they insure loans, basically. It's a government agency. They insure loans to make it easier for people to qualify for them, just to make it as general as possible.
Sure.
So for folks that are working on their credit, FHA might make the most sense. Or for folks that are military, VA loans. Everyone who's in the military knows about VA loans. You can buy a home with 0% down.
Yeah.
So depending on where you are on the credit spectrum, if you're not military, if you're looking at conventional or FHA, a conventional loan, you can buy a home with as little as 3% down typically.
Yeah.
Most commonly, you can do 3% down. FHA is 3.5% down, so it's not significantly different. Go ahead.
So what you're telling me is for the majority of loan types, you don't get to get in this thing with a 100% loan where we're just going to borrow all the money.
Correct.
Buying a house isn't free.
Absolutely.
In a nutshell. You need to have some money saved up in order for this transaction to go through. And how much money you have saved up is going to impact what kind of loan types make sense for you.
Correct. Yeah, you almost always need to have some saved up, and with the exception of your military veterans with the 0% down. But it's important to realize that even with the military VA loan with 0% down, more often than not, the buyers these days are also going to be obligated to pay for closing costs up front. So
that's a vocabulary word for us. So,
exactly right.
So closing costs and down payment. Those two categories broadly are what it's going to cost you on settlement day to purchase this house. This is the cash you need to actually have saved up for this transaction to move forward. Closing costs in Virginia, I can speak to as the realtor here. Generally, 2 to 5% of the purchase price is pretty typical in Northern Virginia. In another state, you'll have to ask that state's realtor. But around here, that's typically, and I find it usually comes right around 3%. And what a closing cost is it's going to pay your lender, your realtor, the taxes, right? Mm-hmm. It's going to be paying for insurance and a whole slew of other things that are going to be taking place on settlement day. Where can people source the funds that they need for closing costs? What are the different avenues we can go ahead and get them? Because it's not just the money you have in the bank. There can be other ways of getting it. So What are those other ways?
Great point. And so most commonly, the checking and savings account is the easiest way to go when it comes to paying your down. If you have like stock or something like that, different investments, you can sell them, and use those for funds for the down payment. You can even take loans against certain types of investments. Like if you own one home, you can take a loan against it to use that money for the down payment on another property. The important thing that we're realizing is that we can source where the money is coming from. Right. So you run into issues with folks that might have, if you have money saved up under the mattress somewhere and it's just in cash, it can present issues.
That's going to present issues. People are going to wonder where that cash came from. The mattress excuse doesn't really hold too much water.
Right. So for like anti-money laundering reasons, like we need to explain where all of the money is coming from, right? Yep. So if someone has cash under a mattress and they just take it and they deposit all of it in their bank account all at one time, and when we're
that's
looking,
a red flag.
It is. So when we're looking through a loan, one of the things we're looking at is bank statements. We'll see that deposit hit there, and we're going to have to explain where it came from. So if there's a deposit that's more than half of the borrower's qualifying income, and we don't have a way of explaining where it came from, it's just cash from under the mattress, we really may just not be able to use those funds.
So what are some other ways? So some other things that I've seen is family gifts. Do you want to talk about that?
Sure, absolutely. So if you have a family member of yours that's willing to contribute to your purchase here, if mom and dad said that they were going to be willing to help out, they can, in fact, contribute gifts towards your closing costs. In fact, they can give you your entire down payment if you'd like. Nice. And so gift funds, like if a family member wants to, blood relative, that's one thing. You can run into issues if it's just a friend of yours that wants to gift funds. That can be a different situation depending on the loan program. But generally speaking, like a parent or a sibling or even a child of yours, if you're older and your son or daughter wants to contribute money towards the down payment, they can do that. Yep.
Okay. And then the last thing that I've seen happen pretty frequently actually is during the negotiations between buyer and seller is we can actually have the seller agree to pay for some of your closing costs. Now, they can't contribute to the down payment, but they can pay for the closing costs. So that is another avenue to help you come up with the necessary assets in order to move forward on the transaction.
Right, absolutely. So just kind of circling back to our conversation earlier, talking about assets in general and what you need to have saved up to buy a home. You said 2 to 5%, call it around 3% is a general rule of thumb for what your closing costs usually come out to. So if you think about that's what your down payment is, and say you have good credit and you're doing a conventional loan, 3% is what you'll do for the down payment as well. So down payment 3, closing costs 3%. You need about 6% saved up to buy this home.
That's as a rule of thumb. That's pretty. Yeah.
Now, if you happen to find a situation where the home you're buying, maybe you're the only offer. You're not fighting over it. There's not 3 other people that are throwing cash at it and really, really want this home. If you're the only one and you're negotiating, you can ask for the seller to help contribute to your purchase through closing costs, just like you said. So conventional loan, if you're putting 3% down and your closing costs are 3%, the seller in that situation can credit back 3% of the purchase price towards you. And that would cover your closing costs almost entirely.
I've actually seen scenarios where veterans, through a mix of these seller subsidies and the low or no down payment requirements, I've actually seen scenarios where they receive a check on settlement day. They're walking away with a house, keys in hand, and a check.
Yep, it's wild. People don't realize that you can do that, but
it's possible out there. So, with all these things, it's a constellation of different things that impact your end result, which is why it's so helpful to have someone like Coleman on your team to guide you and to show you, hey, look, I know you thought you needed 6%, or gosh, there's myths out there that you need 20% or more, right? Or you think the market is so strong that you have to have cash buyers. I was looking at the statistics recently, and of like the last 5,000 or so transactions I went through, there was only 600 that were actually cash buyers. So it's not true, even in a market like this that's really competitive.
Yeah.
So yeah, getting sound advice can help you really find a way better result. But let's turn our attention to the third subject.
Credit.
What's the third thing?
Absolutely. So we've talked about income, talked about assets. The third thing, credit. You almost might put this first because your credit score is going to determine, whether or not you qualify for a loan. It could, and which loan is going to make the most sense for you. So I alluded to earlier, if you have perfect credit, and this is for folks that are not military. If you're military, VA loans are almost always the best bet for your first purchase. But for civilians, great credit, conventional loan is going to make the most sense. If you're working on your credit, if it's in the lower 600s, you may not qualify for a conventional loan. You may need to look at an FHA loan. They're not bad at all. In fact, they're great. They're great loans for certain scenarios. And
now I want to pause you here. I know you're not done with your thought, but I want to understand, why would you say that one loan type might be better than another loan type in terms of a person's situation? If they have good credit, why would a conventional end up better for them?
Sure. So they're going to have different interest rates, first of all. That's one thing to consider.
Okay.
It's funny that FHA loans are sometimes you might get a slightly better interest rate than a conventional loan. Folks don't realize that. But the thing that kills you with FHA loans is something called mortgage insurance. So it's different, right? Or MIP, as they actually call it on
MIP.
FHA. Right, yeah. PMI is for conventional, MIP is for FHA.
Yeah.
But it's a monthly and upfront cost. They charge you 1.75% of the purchase amount as an upfront mortgage insurance premium.
Yeah.
It's just a fee really that you're paying. It gets financed into the loan. But that's one thing that happens on FHA loans that doesn't typically happen on conventional. It can. And then monthly too. It's monthly mortgage insurance too.
Correct me if I'm wrong, but when someone looks at that and they say, well, why would I want to have to pay these extra costs? Or why should I have to? Why do they exist? In my mind, it's because credit, as a rule of thumb, is just how well do we trust you that you're going to pay this back? And I look at these costs that you're mentioning as sort of this is the cost of you not having as solid of a track record paying it back. This is one of the reasons why it's so important to build solid credit. It will save you money, right?
Right.
Because in order to make it worthwhile for a lender to lend you hundreds of thousands of dollars, they need some sort of compensation for the fact that someone with low credit is a riskier, that's a riskier person, and that's a riskier investment.
Right. Overall, that is basically true. In the FHA, it's a government-sponsored agency that insures loans. They're not actually funding these loans. They just insure the banks in case someone were to default on an FHA loan. They come in and bail them out, basically. So, and if you're somebody that's working on your credit and you're thinking about, you've got, you could spend money paying down loans and doing student loans or trying different things to get your credit up, and you don't qualify for a conventional loan, it doesn't necessarily mean you should wait. It doesn't mean you should wait all this time to where you could qualify later. If you can buy it with an FHA loan now, your credit will be going up over time. Later on down the line, maybe you refinance into a conventional loan. You can always do that. Yeah.
I mean, heck, even having a record of you paying these mortgage payments over the next year is going to help build your credit.
Significantly.
Yeah, significantly. Okay. Well, Coleman, I think that's been a really great start to help people learn the foundations. Actually, you know what? Before we wrap up, there's one more thing that you mentioned, the bonus fourth thing, which is talking about the property. Right? This has less to do with the person, but it is an important piece of the pie, because I have rolled up to a showing before to take a look at a property, and I had to let my buyer know, like, hey, look, man, I don't think you're going to be able to get a loan for this property. There's a hole in the wall of the building.
Right.
So maybe I'm getting ahead of myself, but what do you have to say about the property being part of this process?
Absolutely. So when we're lending this money, it's collateralized by the loan. So the bank is giving you this money specifically, to purchase this home. And if you had ever stopped making mortgage payments, they do have the right to foreclose and take that property back. So we're lending on that actual property. And so the bank themselves, in order to be comfortable lending money on a property, they want to make sure that property itself is in solid condition. Like,
Yeah.
you know, a bank wouldn't want, for example, if you were the bank, you wouldn't want to lend somebody $500,000 if you know the home is only worth $200,000, because
Yeah.
if they stop paying and you need to take
Yeah.
the home back, well, you've already given them $500,000, and so taking a $200,000 property back doesn't do you a ton of good.
Yeah,
So-
and it may be beyond the scope of today's lesson, but at some point we should have you back to talk about the differing standards between the different loan types, right? Because there is an inspection that actually goes on
Sure.
when you hire the appraiser to come out and take a look at the property and try to determine that independently evaluated valuation
Definitely.
of the property.
Like, as a rough rule of thumb, you know, FHA and VA appraisals are typically a little bit more nitpicky on appraisals than conventional loans are.
Yeah.
And so that's something to consider if you're looking at a FHA or VA
Yeah.
loan.
Yeah.
The other thing when it comes to looking at the collateral is a lot of folks don't realize, like, condo fees and HOA fees
Yeah.
are they're different on every single property, and they impact. The bank actually looks at the condo or HOA fees
Yeah.
when they determine whether or not you qualify. So, like, if you qualify for a $500,000 property, assuming there's no HOA fee, you might look at one, you might think you're good to go. But if you look at a condo that's $500,000, it's probably going to have a monthly fee attached to it, a condo fee,
Yes.
right? And that could, when put into your debt to income ratio, it could kick you out of qualifying.
That's right. That's right. That's a big part of the discussion, actually. I talk to a lot of people when they're first getting started, and they go and they get their pre-approval letter, and it says $400,000. Okay, but that's $400,000 for a townhouse that has no anticipation of paying condo dues. But that's not going to be $400,000 for a condominium that's got $500 a month condo dues. That's going to bring how much you can afford down. Right, which is not going to be 400, maybe it'll be 350. It just kind of depends on interest rates and other things that you'll know that I won't necessarily. But the principle is still the same. Where this is, it's like one more thing affecting the debt to income ratio part of the discussion, right?
Yep.
Because those condo dues would be another obligation that you'd have to
Yep.
factor in when you're calculating what you can really afford.
Yep. So just like a car payment can knock you out of qualifying, so can a condo fee or a town or HOA fee.
Yeah,
You know?
and it doesn't mean the condos are bad. It just means that
Not at
you
all.
need to look at each one individually and not be reckless or too quick in your estimations, right? This is why you have a professional that you can run something by anytime you're interested. So Coleman, let's wrap this up a little bit here by talking about what are some key takeaways. And I know at this point, oftentimes we are all tempted to say, hey, just do X, Y, and Z, and then you'll be golden. Like, just perfect your credit, make a lot of money, and bank it. It's like, okay, that's if we could all do that, it would be so simple. But realistically, what's the path forward for people?
Absolutely. So first and foremost, you know, we talked about credit, and so, you know, if you're in the 700s, you're golden conventional loans. If you're in the lower 600s, we can still work with you. 500s, you know, we may need to work on it a little bit, but, you know, I do have some tools and can kind of guide people a little bit on how to improve the credit over time. So that's credit. Income, you know, if you're a salaried worker, we could probably just immediately qualify you off that income. If you're variable income or your sales, counting commission, you know, we'd probably need more like a 2-year history. And then, you know, as far as assets go, you know, you ideally want to have your down payment and closing costs saved up and ready to go before you make a purchase.
Yeah.
Exceptions to that could be if you have a family member or somebody who's going to be willing to gift a down payment.
Yeah.
Or as far as closing costs go, which, like we said, 3% is a good rule of thumb. Sometimes if you find a property where you're not fighting over it with other people, you can negotiate where the seller will pay your closing costs.
So notice how the question of trying to bring it tight into just do X, Y, Z and you're good is not really that easy, because there's so much that is unique to each situation. So what I usually recommend to people, anytime people ask me anything related to the finances to be able to afford a home, I just say, talk to Coleman. Talk to Coleman, right? Because whatever I tell you is not going to be as useful or as practical, right? Something that you could implement today as what Coleman's going to be able to do after looking at your whole. It's kind of like going to the doctor's office and saying, fix me. It's like, okay, well, I need to diagnose you first. I need to know where the problem is and what is actually going to work for you as an individual, right? So what you need to do is talk to Coleman.
I appreciate it. Yeah, no, I mean, I talk to people all day long that are just currently renting. They're not sure what they could afford. They're not even sure if they're interested in buying, but they're curious to know, can I buy? Like, what is my
Yeah.
budget? And if I want to buy, what do the numbers look like? How much does
Yeah.
it cost? And, how does it compare from an investment standpoint to buy as opposed to rent?
Yeah.
So I'm always happy
Yeah.
to have a conversation with somebody, and I've got a bunch of cool tools to kind of compare that rent versus buy
Absolutely.
question. If you-
Absolutely. I mean, like a common one that I get with people is they'll say, "Hey Dan, is it better off for me to take this money that I have banked and use it as my down payment, or is it better for me to use it to pay off my car so I have less debt?"
Mhm.
And I say, talk to Coleman.
Absolutely.
Because I don't have enough information to know which one is actually better for you yet.
Yep. Very case by case. Very much so.
Yeah. So I hope that was helpful for everyone out there. If you have questions, Coleman, how can we get a hold of you?
Absolutely. So if you're interested in applying for a mortgage or want to have a conversation, I can say first and foremost, my website is www.colemanbales.com. That's ColemanBales.com.
Yeah. All right. Okay. Well, Coleman, thank you so much for joining us today. I look forward to seeing you on here again.
Thanks so much.
And everyone, that's it for today's episode. And make sure you like, subscribe, and hit the notification bell. Have a great day, everyone.
Love it.